Hey everyone, and welcome back to my channel, or if you're new here, my name is Josh and I make videos all about personal finance. So if you're interested in that subject or you happen to find the content in this video to be valuable, I would definitely appreciate you subscribing to my YouTube channel. So in today's video, what we're going to be discussing about is the old age, kind of the argument of whether or not you should pay off your home mortgage early or whether you should use that extra money that you may be accumulating to invest into the stock market. Now, before I get into this video for today, if you would like to go ahead and grab a few free stocks from Webull, definitely make sure to take advantage of those by clicking my link, which you will find in the description box below. Okay, so before we get into some of the pros and cons of paying off your mortgage early, I'm first going to run through a little bit of a scenario. So we have a couple of different characters in the scenario. The first character's name is going to be Josh, and then the second character is going to be Dave. Now, Josh, he has some extra income coming in. He has a mortgage. Dave also has a mortgage. Both their mortgages are going to be for $285,000. That's because they purchased a house that was $300,000. They put a 5% down payment that was $15,000, and now they're left with a loan of $285,000. Now, the interest rate was also the same. Their interest rate is going to be 4.5%. That's going to leave them with a monthly payment of principal and interest of $1,444. Of course, they're also going to have homeowners insurance. They're also going to have property taxes. They might have an HOA. We're not going to be including those extras. We're just going to be including the principal and interest payments, and both of them are going to have a principal and interest payment of $1,444 every single month. Now, Josh and Dave, they both have $500 extra at the end of the day that they can do whatever they want with. So in this case, Josh wants to go ahead and put that $500 into the stock market every single month. Dave, on the other hand, he doesn't really like having this extra loan. He wants to pay the bank off as quickly as possible. He doesn't want to have that payment anymore. So Josh, with this money, he puts the $500 into the stock market, into an index fund like VU or some other type of ETF. Dave, on the other hand, he doesn't want to invest in the stock market. Like I said, he just wants to pay off this house as quickly as possible. So instead of investing any of this extra $500 into the stock market, instead he goes ahead and throws that every single month into his mortgage as a principal only payment because he wants to pay down the principal as quickly as possible. So in this scenario, if Josh pays $500 extra every single month into the stock market and doesn't put anything extra into the mortgage, into the loan, he's obviously not going to pay off his mortgage early. It's going to take him 30 years to do so. Dave, on the other hand, it's only going to take him 18 years to pay off his mortgage if he puts $500 extra into the loan and principal only payments. So after 18 years, Dave is no longer going to have a mortgage. He's going to be able to walk into his backyard. It's going to be his. He's not going to owe the bank any extra money. Sure, he'll have property tax. Sure, he'll have homeowners insurance, maybe HOA dues, other things. But that big payment of $1,444, guess what? That's going to be gone. So after 18 years, Dave will have no mortgage, but unfortunately, he won't have any money invested. He'll have $0 in the stock market. On the other hand, since Josh was investing $500 every single month into the stock market, he was gaining a 10% rate of return every single year on average. And then after 18 years, he's going to have $288,199. Now, Josh still has 12 years left of his mortgage, so he's going to have to continue paying $1,444 every single year for the next 12 years. So Dave is feeling pretty good about himself. You know, he doesn't have a mortgage. He has all this extra money free to do whatever he wants to do with it. Josh, on the other hand, he's also feeling pretty good because he has $288,000 in the stock market. He's doing great. He's accumulating for the future. He's going to have a pretty good path to retirement at this point. However, he still does have 12 years left of his mortgage, but with inflation, he's been making more with his job, so that $1,444 payment really isn't as much at this point in time. So now we're going to fast forward another 12 years. At this point, like we mentioned, Dave did not have a mortgage. He did not have to pay $1,444 every single month. So he had all that extra money. And then of course he had $500 extra to spare. So he had $1,944 in total to play with. So since he didn't have any money in retirement, he didn't have any money invested. So what Dave is going to do in this scenario is he's going to invest the total $1,944 into the stock market to sort of catch up for retirement. Now, he just has 12 years to catch up, but $1,944 is a lot to invest. So over 12 years, investing $1,944 every single month, he's going to end up with $525,480 after 12 years of investing. Now, Josh, on the other hand, since he still has a mortgage of $1,444, he's still going to invest $500 every single month. And then, of course, he also has kind of that starting amount of $288,199 in the stock market. So he sort of already has kind of a snowball effect going on where he's earning a lot of interest off that money in the stock market as it continues to grow 10% each and every year. So after 12 more years of investing $500 every single month, Josh now has $1,039,646 invested, whereas Dave only had $525,480, even with those catch-up payments of $1,944 every single month. So as you can see in this scenario, after 30 years, Josh nor Dave has any type of mortgage. Dave had no mortgage for the last 12 years. Josh had to pay every single year for 30 years. But at the end of the 30 years, since Josh started early with investing, Josh actually ended up with $514,166 more in wealth, since Josh had $1,039,646 and Dave only had $525,480 invested. So as you can see, mathematically speaking, it's going to be much smarter to invest early on and put all that extra money in the stock market if, of course, the stock market continues growing at 10% each and every year, which we really don't know whether it will. It has for a long period of time, but is it possible that the stock market could flame out and just never grow again? Certainly, but most likely, mathematically speaking, it would be smarter to invest in the stock market. However, psychologically speaking, just not having a mortgage is also going to feel great, just because Dave in this scenario, he didn't have a mortgage. He had all this extra money, $1,444 each and every month that he didn't have to pay. His expenses were much lower. He still had other expenses to pay off, such as groceries, maybe his HOA, property taxes, homeowners insurance, and just other expenses in life, but his expenses were much lower and he was feeling pretty good about himself. So just real quickly, we're going to be going over some pros and cons of paying off your mortgage early. First off, we're going to talk about some of the pros, and a lot of this relates about what I just talked about. So the first pro is you're going to have a lot less expenses to pay off each and every month. It's going to free up cash flow to put to other areas. So maybe you always wanted to travel more. You're going to have a lot more money to work with to travel. You're going to be able to go to restaurants more if that's your thing. If you like going out to eat a lot, you're going to have more money for that. And you're just going to have a lot more flexibility. Let's say that you just absolutely hate your job, but you have to stay at your job to pay off your mortgage. Well, guess what? Now that you don't have that mortgage to pay off, it's going to give you the flexibility to switch jobs, maybe to a job that even makes less money, but you'll enjoy more. You can switch to that job now just because you have fewer expenses, or perhaps you always wanted to start a business. This would be the perfect time to start a business now that you have fewer expenses. If you still have a mortgage, you're probably going to have to stay at that job that you dislike just because it makes money and it pays the bills and things like that. If you don't have a mortgage, it gives you more flexibility to either switch jobs to something more enjoyable that pays less, or perhaps you can even start your own business. Now, we're going to be going to some of the drawbacks of paying off your mortgage early, and that pretty much, once again, relates to this video. It's pretty much the opportunity cost of investing, because in this scenario, Josh ended up with around $500,000 more in wealth than Dave, just because he invested $500 every single month into the stock market, whereas Dave wasn't investing a single penny into the stock market until 18 years after he finally paid off his mortgage, and then he was investing the mortgage payment plus the extra $500 into the stock market. It's a lot of catching up to do, and he still fell well short of Josh. Now that's where we sort of go into a happy medium, and we have the third person, and that is Michelle. And Michelle is going to put $250 into the stock market and $250 extra into her mortgage. That's sort of your happy medium. And in this case, what Michelle is going to end up with She's going to end up paying her mortgage in 22 years instead of 18. So it's going to be a little bit longer, but she's not going to be paying her mortgage for the full 30 years. And then at that point, after the final 8 years, for the final 8 years, she's going to be investing $1,944. That's a mortgage payment of $1,444 plus the extra $500 that she's earning. And then after 30 years, she's going to end up with $764,700. So she's not going to be making as much as Josh by investing the full $500, but she is going to be making more than Dave. So it's sort of your happy medium. And I think that's really the best way to go about this scenario is to, yes, maybe you do want to pay off your house early. You're paying a little bit extra towards your mortgage in principal only payments every single month or perhaps every single year. But at the same time, you're also investing this money and putting some money aside for an emergency fund, just so you have some money for retirement at the end of the day, and then perhaps you'll have your mortgage paid off a little bit early. But at the end of the day, there is really no right or wrong answer. You're not dumb if you pay off your mortgage early, and you're certainly not dumb if you decide to invest extra money into the stock market and pay off your mortgage after 30 years, or perhaps you want to extend that into the future and just never pay off your mortgage. I can definitely understand points of views. It really just depends on how risk tolerant you are. If you're very risk tolerant, maybe you would invest more into the stock market and try to see more growth over time. But if you're not very risk tolerant, perhaps you just want to pay off your mortgage earlier, and that's definitely fine too. So again, there is really no right or wrong answer here, but if you look at the numbers, mathematically speaking, not talking about these psychological factors, mathematically speaking alone, it would definitely be smarter to invest the extra money into the stock market, letting that money grow, because if it does grow at 10% every single year for the foreseeable future, you are going to end up with more wealth that way. Of course, there are those other psychological factors that you do need to keep in mind, so maybe you just have a happy medium. But on that note, I'm going to go ahead and wrap up this video. If you did find value out of it, I would definitely appreciate you giving this video a like, as that does definitely help out with YouTube algorithm. And of course, subscribing to my YouTube channel so you will be the first to know when I do release future videos. So thank you guys once again, and as always, I'll see you in the next video.